Welcome to our channel, Management Accounting Made Easy. Here we are going to see Introduction to Relevant Costing. This is our part 1 of Relevant Costing. We are going to see what is a relevant cost. Any costs which are affected by a business decision making are relevant costs. So in simple, relevant costs are avoidable costs when making business decisions. So you can avoid these costs if you don't make that particular business decision. And also these costs are future costs. As I have mentioned, these are avoidable cash flows. When deciding a relevant cost, we need to think what are the future cash flows that are affected by the business decision. So relevant cost will be incurred in the future. They are cash flows. So we are going to see the two important characteristic features of relevant cost. Number one, they will occur in the future. But we have to be very careful here because not all future cash flows are relevant. For example, a company is entering into a hire purchase or leasing contract. The hire purchase payments or leasing contract payments are going to be in the future. So the company has committed to pay these payments in the future. So these costs are called committed costs, but committed costs are not relevant costs. And also, relevant cost will be different for different alternatives. We are going to see some business decisions where relevant costing can be useful. So before that, we will see whenever businesses make decisions, what they will do is they will see how much additional revenue we are going to get from that particular decision and how much extra or additional cost they're going to incur from that particular decision again. So if the additional revenue is greater than the additional cost, then it is worth undertaking that decision. So we are going to see some business decisions where relevant costing can be useful. The first one, shutdown decision or closing of a business unit. So when making this decision, businesses compare the cost that can be saved due to the closure and the revenue lost when they close that particular division. So if by closing that division, if they can save, for example, £10,000, and the revenue they're going to lose, for example, £3,000 from that division. So obviously, it's better to close that division because the cost savings is more than the revenue they're going to get it from that division. The next business decision could be make or buy decision. So what they do is they need to compare the variable cost of making that particular product with the cost of buying, because we don't take fixed cost into account. As we all know, fixed cost is not relevant because we are going to incur that fixed cost anyway. The next one-off contract decisions or special order decisions from customers. So if a client wants a price quote for a special order, management should only consider the variable cost of making the product, such as the material cost or labor cost, and not the fixed cost. Because as we all know, again, the fixed cost will be incurred anyway. For example, factory rent or manager's salary. The next one, foreign market entry, further processing decisions, or plant replacement. We are going to see different types of relevant costs. The first one is variable cost or marginal cost. Generally, variable cost or marginal cost, they are relevant costs. But we need to look at the situation when deciding. For example, material cost is a variable cost. But if the company has already bought the material and the material is in stock, so that means the company has already paid for it. So that cost is a historical cost or sunk cost. So that is not relevant. So we need to be careful when deciding whether that particular variable cost is relevant or not relevant. The next one is incremental cost. Incremental costs are additional costs. They are always relevant costs. Now the next one is the opportunity cost. Opportunity cost means the value of the benefit foregone when one course of action is chosen instead of another. So we are going to see two simple examples. Say a company has an idle asset. So this idle asset has a scrap value of £3,000. Now the company decides to use this idle asset in a new contract. So the company is going to lose the scrap value of £3,000. So in this case, the company has given up its opportunity to have a cash inflow of £3,000 from the sale of an asset. So that £3,000 is a relevant cost. That is the opportunity foregone. Now we'll see another example, that is skilled labor. So the skilled labor which may be needed on a new project might have to be withdrawn from the usual or the normal production of a company. So this withdrawal could cause a loss in contribution, which is obviously relevant to the project because you are taking the skilled labor from the usual production. So that usual production will be affected. So because of that, the company is going to lose contribution from the usual sale. So that loss contribution will become as an opportunity cost, and opportunity cost is a relevant cost. Now the next one is avoidable cost. If a company can avoid a cost by undertaking that decision, so that avoidable cost will become as a relevant cost. Now, fixed costs are usually irrelevant, not relevant. Fixed costs are not relevant usually. But if you have an attributable or avoidable fixed cost, or we can say step fixed cost, they will become relevant because, say for example, a company is undertaking a special order. Because of that special order, the company has to hire a new factory space. So that high cost of that new factory space could have been avoided if that particular order has not been undertaken by the company. So in this case, the attributable or avoidable fixed cost will become as a relevant cost. Now the next one, specific costs which are related to a particular decision, this will become as a relevant cost. In our previous slide, we have seen the types of relevant costs. Now here we are going to see the types of non-relevant cost. So we'll see what is a non-relevant cost. Any cost which are not affected by a business decision making is a non-relevant cost, or any cost which do not change with the new decision. So that cost is a non-relevant cost. So non-relevant costs are to be ignored when businesses make decisions. So we are going to see some types of relevant costs. The first one is a sunk or historical cost or past cost. So sunk cost is a cost which has already been incurred. So those costs cannot be reversed. A new decision will have no effect on this cash which has already been spent. So we'll see some examples. Material cost, the material which has already been purchased. So that cost is already been incurred. So that is a sunk cost or historical cost. Say a company has already purchased a machinery. So that is also a sunk cost. Money spent on market research for an introduction of a new product. So this money has already been spent. So this is a sunk cost. So these costs must be ignored when businesses make decisions. The next one is a committed cost. Even though these costs are future costs and going to be incurred in the future, but these costs cannot be avoided because the company has already committed to incur. So example, leasing contracts, hire purchase contracts. So the company is going to pay these installments in the future, but this has already been committed, so they're not relevant. The next one is common cost, like factory rent. The company is not going to incur any extra factory cost, factory rental cost. So that is called common cost. So that is also not relevant. The next one, non-cash expenses. As we all know, relevant costs are future cash flows. So any non-cash expense like depreciation or amortization of goodwill, these are not relevant. The general and administrative overhead cost. General and administrative overhead cost. These costs will be incurred anyway, so these are not relevant. The next one is called notional cost. Notional costs are imaginary costs. Okay, so imaginary cost or speculative costs or conceptual costs, these are notional costs. So these notional costs are not relevant because these costs are something that has no actual existence. They are all mere imagination. Say, for example, a GP surgery has its own building. Okay, the notional rent of that GP practice is if they had paid rent, how much they would have paid. So that is an imaginary cost. Same way, notional interest. So any notional cost is not relevant. The next one, book values of an asset. The book values are not relevant because these are based on the past cost. So they are not relevant. So we have seen some or types of non-relevant cost. Now, relevant and non-relevant costs are mutually exclusive event. That means if a cost becomes a relevant cost, that cost cannot be a non-relevant cost. Okay, so if I say that again, a cost item in one situation cannot be both relevant and non-relevant cost at the same time. As we all know, in order to understand a topic thoroughly, you must do as many questions as you can. So here we are going to see this example, Alexis Limited. So we'll have a quick look at the question. Alexis Limited has a machinery which was bought in 2019 for a cost of £35,000. It would cost £33,000 to replace the machinery. The machinery has a scrap value of £10,500. Now, Alexis Limited is planning to use this machinery in a small project which would earn a net income of £22,730. Apart from this, the asset has no other use. So the question is, calculate the deprivable value of this asset. So we'll see how to calculate the deprivable value. So the deprivable value, we got to compare the replacement cost with the recoverable value. Then we got to take the lowest out of the two. Okay, that's our deprivable value. Now, the replacement cost is given in the question, 33,000, but they didn't give us the recoverable value. So we need to find out the recoverable value. So the recoverable value is higher of the net realizable value. So the net realizable value is given, which is 10,500. That's the scrap value. And also they have given the economic value in use, which is 22,730. So we need to compare the net realizable value of 10,500 with the economic value in use, which is 22,730. Now, the recoverable value is the highest of the two, so which is 22,730. So the deprivable value, as we have seen before, the lowest of the recoverable value and the replacement cost. So the deprivable value of this asset is £22,730. This is a popular multiple choice question. And deprivable value, basically the relevant cost of this machinery. We are going to see the next example called the Olympia Limited. So we look at the question. Olympia Limited owns an idle asset with a net book value of £3,750. The company is planning to undertake a 1-year contract. This machine could be used for this contract. If not, Olympia Limited can sell this machine for £1,500. After the use on the contract, the machine will have no scrap value and would have to be dismantled. So the dismantling cost would be £950. Calculate the total relevant cost of this equipment if Olympia used this on the contract. So we'll see. Now, if Olympia is going to use this machine in this particular contract, the scrap value will be lost. So we are going to see the final example for this slide, which is the Garment UK Limited. So we look at the question. Garment UK Limited manufactures and sells all types of garments. The variable cost per making a shirt is £5.50 and the selling price per shirt is £10.75. So we can calculate the contribution per shirt is £5.25, which is the selling price 10.75. Take away the variable cost 5.50. So the contribution per shirt is £5.25. Now we'll continue with the question. Garment UK Limited has spare capacity to produce 7,500 units of shirts. A new customer has offered a one-off order to buy 7,000 units of shirts. So that means for this particular contract, Garment UK Limited would not incur any extra fixed cost because they have spare capacity at a price of £9.50. If this new order is accepted, the existing sales is expected to fall by 3 shirts for every 20 shirts sold to the new customer. Okay, now we look at the question. Is it worth accepting the new order? Okay, so we'll see the total contribution from the new order. So 7,000 shirts we are going to sell. Okay, the contribution from this new order per shirt will be £9.50 is the selling price. Take away the £5.50, that's our variable cost. So £4 per unit is the contribution from this new order per shirt. So 7,000 times 4, which is £28,000. Now, we are going to lose contribution from our existing sale, which is every 20 shirts we are selling for this new order, we will be losing 3 shirts from our usual sales. So 7,000 divided by 20. Okay, so 7,000 divided by 20, we will get 350 times the 3, times it by the contribution per unit of the existing sales, which we have calculated before, that is £5.25. So the lost contribution from the existing business will be £5,512.50. I'll quickly repeat this again, the lost contribution, because the question says every 20 shirts, we are going to lose 3 shirts of existing sales. So altogether, we are going to sell 7,000 shirts. So 7,000 divided by 20, times it by 3, times it by our existing contribution per unit, which is £5.25. So the total lost contribution from the existing business is £5,512.50. So the overall increase in contribution and therefore in profit, because there is no change in fixed cost. So whatever increase in contribution will lead to the increase in profit, which is 28,000. Take away the 5,512.50. So that will be 22,487.50. So purely on financial basis, it is worth accepting the order. But we'll quickly look at the non-financial basis. So existing customers, your regular customers, you are selling it for £10.75. But for this one-off order, you are going to sell it at a lower price of £9.50. So this will upset the existing customers, and the existing customers might leave Garment Limited and they might buy it from its competitors. Thank you for watching. If you like this video, please like, share and subscribe. I will see you in part 2 of